And let's start with our state of the market for August 12th, 2020. So I want to show you guys, this is not the statistic just pulled today, and it shows the May, June, and July's number. And, as you see, of course, we are recovering from May. May, we had a really rough month. And July, you could tell that we started recovering. And July, my gosh, for us, even our team in July, we had worked with so many buyers. The competition out there is real, is pretty fierce. People just came back and then made a lot of offers. So you could tell that there are a lot more listings coming out. There are a lot more offers being written, and then there are a lot more offers being closed. And then here is also, you see the change to pending 2019 versus 2020 and May for May, June, and July. As you see that here is that in 2020 July, we have 20% more 20% more pendings, meaning contracts signed, compared to last year of July. So the number had gone up quite a bit. And again, we had mentioned before that summer typically is a slower month, but this year our spring had started in June instead of in February and March. And I'm including these two charts to let you compare from last month to this month. Last month, Clara County Association had put out this infographic, basically showing that closed sales was 857 for single family. But this month, not this month, but last month, July, it was 1,004. And it had gone up 17% compared to a month ago and 11.8% from 1 year ago. Condos, same thing, it had gone up quite a bit. What's interesting about this chart is actually that if you see the condo prices, last month we showing is like dropped 11%, but this month in July, it has shown that it has gone up 3.3%. But we do notice that a lot of like the condos have been on the market a little bit longer, and they tend to not get as many multiple offers compared to single family residents. And single family residents, you could tell right away that if homes are in a good location with good school districts, it still has a lot of multiple offers. So the number of days right now, it has gone up slightly, but in general, it's still a lot of places have been on the market for about 2 weeks. We see a lot in less than 2 weeks, and then they are basically have multiple offers. And I want to show you a little bit from San Mateo as well. Same situation, because earlier I showed you from Santa Clara County. I would like to show you a little bit from San Mateo County. 1.72 million is the median sales price, and 30 days average days on the market. And also they have 434 closed sales out of 500 listed. This is for single family. And then it's very similar for condos. It seems like the market really had picked up in July for San Mateo County as well. And then this one is East Bay around the 880 corridor. And you see that these are the cities around the 880 corridor, and most of them had gone up as well in terms of the median sales price, besides the Berkeley and Albany. And you do notice that like Union City has gone up 9%, San Leandro gone up 9%. So a lot of these East Bay area, their pricing actually had gone up. And then most of the time we even from my personal experience, we have talked to a lot of buyers, and some of the buyers truly indeed, they are moving out of San Francisco, going to East Bay or going south to the peninsula or even the South Bay area. And I want to share a little bit of like, we talked so much about this before too, April survey, July survey. I mean, from our own survey with our own clients, we hear over and over again, they need more interior space because of work from home. They need more outdoor space inside the house. Even if they're looking for townhouse, they need a little bit of a backyard space. They want to move from the city to the suburbs. They want more they want to have the space that is their own instead of have any shared space with other people. So that is like really a trend that we start to see, especially during this past couple of months. And most of the organizations, they're still projecting that the future home price is still going up slightly. Zillow is funny. Zillow hasn't given their opinion about like their future home prices projections, but only two organizations, CoreLogic and House, is projecting a slightly decrease on the home prices. But Zillow, again, Zillow CEO had talked about like this real estate market is beginning great reshuffling as people seeking more space right now. And here is some reports that I pulled from Marcus Millichap, their research center. It has shown you guys that the employment market right now, and maybe Dr. Souza, you have some opinion about this. I just pulled this up, and they have talked about the employment percentage change in Oakland, San Francisco, Orange County, Los Angeles. They're all double digits. In a way, I'm in San Jose, so I was glad to see that we are in single digit, not double digits. But no matter what, it is still definitely have quite a impact in terms of the employment percentage. But then the temporary layoffs here, what interesting is that we do see a lot of temporary layoff being rehired compared to the permanent layoff. So, which is good news. I think that's a little bit positive to look at the economy in general. And then if we look at the residential loan side, we do see that mortgage credit availability has gone down. We have heard like a lot of banks with the jumbo loans, they don't allow any more less than 20% down payment. Some of them require a little bit higher FICO score, and then some of them actually don't take certain income anymore. So it definitely has become more stricter. And also average days to close a loan. I know this numbers, it says 47 days. Fortunately, we still have pretty good experience actually. We still have people, a lot of our clients closing loans in 30 days or even 25 days. But then we also have one bank that have been closing loan much longer. It is about 47 days, and it was getting pretty nerve-wracking for us. But so in general, just to let everybody know that if you are writing offers, just be sure to talk to your loan officer, making sure that you know their timeline, because if you know they pass that 30 days closing and then you cannot close and your seller is not willing to extend, it can be pretty detrimental to your buyers. And I thought this is also quite interesting from Mortgage Bankers Association. They have saying that commercial and multifamily borrowing falls 48% in the second quarter of 2020. And but then the share of mortgage loans in forbearance decreases for the 8th straight week to 7.44%. I feel like there's like a bad news and a good news here. I mean, both of you are in the mortgage loan business, especially in commercial. Do you guys agree with this?
Mm-hmm. Yeah.
Absolutely.
No.
Yeah.
No? Marty, what do you see?
I think it's really too soon for that second bullet point.
The share of the forbearance decrease?
Yeah, I mean, that's early. It's
Yeah.
going to get a lot worse.
That's right.
And so that's why I push back on you guys on that.
That's fine. So again, thank God this is not my words. It's just from Mortgage Bankers Association. And this is actually in August it came out. They were saying that it has decreased for 8 straight weeks to 7.44. I believe the forbearance had decreased, but then is it going to lead to foreclosures in the future? I wait for you guys to talk more about it later.
Mm-hmm.
And the mortgage interest rate here is that, as you see, especially residential mortgage interest rate had been coming down. And I pulled this one, again, this is from Wells Fargo. They went down to 3.125 for 30 years fixed as of today. Again, reminding everybody that just because they said 3.125 doesn't mean that everyone qualifies for 3.125. It really depends on your qualification. But just to give you an idea is that last time when I showed this slide, it was 3.25. So it did drop a little bit.
Hey, Helen?
Yes?
Are they still requiring like deposits of like $1 million to get that?
The what? I'm sorry?
Is Wells still requiring that the client bring like $1 million?
Well, not in order to get this number. I know that we have client who brought in $1 million to Wells Fargo and dropped below 2.75.
Okay.
Yeah.
Thank you.
Sure. I didn't pull this here, but there's another mortgage broker. It's a wholesale lender. They've been advertising like at 1.99% or something, but you have to pay all these crazy points in order to get that. But of course, they don't talk about it up front. So a lot of people fall for that. Well, the projections You know, this one, I circle all these, the red meaning that from last time I show you this chart compared this time, so about a month, from a month ago. Red means that the projection actually came down, and the green means that the projection actually went up. So as you see that everybody, not everybody, most people have, most organizations have projected that the mortgage rate is going to come down even more for 2020, but then 2021 2Q, the projection now has gone up slightly. So 3.15 instead of, I think it was 3.07 last month. Now let's take a look at the multifamily side. What's going on? This is from Freddie Mac, and they have been showing this, the gross income growth, the growth of the gross income has dropped obviously in 2020. And then also the vacancy rate though has gone up a little bit, but it's quite interesting. It's quite interesting is that you would think, some people might think that, oh, you know, if the income growth have dropped this much, the vacancy rate probably goes sky high, but absolutely not the case. Obviously, we have these eviction moratorium currently, so the vacancy rate hasn't been really been affected that much. But a lot of cities starting to come up because their eviction moratorium is expiring. So a lot of people definitely have been fighting for that. And then here we see that I highlighted Oakland, San Francisco, and San Jose, and then you see the annual change in vacancy rate versus the 2020 forecasted vacancy rate. They're all about right around, the vacancy rate is right for San Jose, well, basically the Bay Area, is close to 6% now. It's like a little bit higher. Before it used to be like lower, it's like 3-4%. It's definitely had gone up for the forecast. And it basically, you know, the vacancy rate is going to increase across all major metros. But they're saying that the highest is actually in Dallas, Charlotte, and also Jacksonville. And then here, this chart, it shows the annual change in vacancy rate versus the forecasted rent growth. And as you see that this is the vacancy rate increase, the basis point increase, and here is the rent growth. So if you're here, that means your rent actually is forecasting to go up a little bit more. And this side, most of the cities is going down. But you see that there's no correlation. Even though the rent growth is going up, the vacancy rate is actually pretty high. They are, you know, 200 to up to over 350 basis point increase despite the rent growth. So this is actually quite interesting graph. Now, we also have been talking so much about that $600 unemployment benefit that expired in July 31st. And that $600 per week on this unemployment benefit covers only 50% of the income in San Jose for the median income over here. And if the unemployment rate remains elevated after the termination of the unemployment benefit from the CARES Act, we are going to anticipate renters to become more cost burdened, resulting in more evictions, doubling up, or moving to lower cost housing options. We have seen all across the United States, every city, you're hearing that everybody was very worried about it. And that's also one of the reasons why buyers are kind of like on hold thinking, I don't know what, you know, how should we even value a property, right? The origination volume is expected to decline in 2020, and it can range from 20% to 40%. But from what they're saying is that the robust growth over the past several years, though, will position the industry to absorb the impacts from this recession. I don't know about this. When I saw this, I was like, I really want to hear what you guys think. Do you really think that because we've been doing so well in the past few years, people pretty much okay for this coming recession? Any thoughts?
Larry's muted.
This is a different ball game.
This is a different ball.
It's a different recession.
Yeah. It just
Well,
seems
I mean,
like.
When you bring this up, Helen, are we looking at it from the residential market? Are we looking at it from the commercial market? Are we doing both?
I think both. I mean, in general, and this is like mostly about multifamily, a lot of tenants. I mean, for the $600 unemployment benefit, it's going to affect a lot of the tenants and landlords. So
I think it's going to be very interesting, and I'm sure Larry's going to go into this, and I hope it's okay to call you Larry. I'm confused now what I should call you, but sure might be better. But I think at least what I'm seeing is every market's going to be drastically different.
Mhm.
And San Francisco, to me, is a tremendous case study right now
Mhm.
that all of this applies to. In San Francisco, because it's so dense, because it's been such a market that's thrived on, you go up there because you're young and it's vibrant and it's fun and there's food, there's entertainment, it's gone.
Yeah.
Yep.
And so then you get the ripple effect where people are going, well, then why am I paying these high rents?
That's right.
And then they go, wait, I can work remotely. And then so you really have a perfect storm where they can start to scatter. And the question is where are they going to scatter? And are they going to scatter east? And when I say that, it may be like an Austin east. Are they going to start coming down to the peninsula and the South Bay? Because I suspect we'll get some coming down this way, which will offset some of the pressures in the South Bay market. But I think San Francisco is in a very precarious situation for a lot of reasons.
I read something that 5% of Manhattan's population are gone. 5%. So if you take that same statistic and apply it to San Francisco, which are very similar cities, you're looking at 40,000 people have left San Francisco since March.
That's crazy. Yeah, I'm not surprised. Literally, I had a call this week. I mean, I get these kind of calls almost every week. And this person told me, I was like, yeah, we're done with San Francisco. We're moving down to the peninsula.
Well, and there's another kind of aspect of the city that I don't think the average consumer even realizes it's behind the scenes, which is, people who live in apartments up there, but then when they wanted to own, they might try to buy a condo. Well, a lot of times they couldn't find a condo. So then they went for, what are those things called that they went for? I'm also like the
TICs.
The tenant in common situation where they would take a multifamily building and in effect do backdoor to create a condo with a huge document like this. Those are now dying because people just don't want to live on top of each other because they're afraid.
Yeah.
And so all these things are going on simultaneously, which will affect multifamily pricing in the city eventually.
That's
because, from a lending perspective, the lenders are going to assume 10 to 25% vacancy now, where they haven't, 5 in the past.
That's right.
And now we're going to be questioning, okay, now we have to look at everybody and go, how many of these tenants have paid? How many of these tenants are holding back on paying because they don't have to? And so then you get another hit to the income. So those people, those investors that were, let's just say, leveraged to the hilt are definitely going to feel stressed.
Yeah.
And the question is whether they're in a CMBS loan, which has more challenges in getting out of those, or are they going to find a friendly bank who's going to be patient with them somehow and maybe convert it to interest only for a while? And I think all of these things will happen at the same time.
Absolutely. Well, we do have this reduced employment benefit for $400 a week now. So hopefully this helps a little bit until end of the year. But there are so many, I think there's just so many things that most people have never seen this before. I get these projections all over. So I that's why I'm so curious. I really want to hear what Dr. Seuss are you going to say. I'm almost done here. This is just something from ABC 7 News talking about all this rent went down this much, double digits, and San Jose at 8%. And then here is Marcus Millichap again regarding Class A multifamily, talking about the higher end rentals in the Bay Area facing the largest correction at this stage of the health crisis. For sure, this is what we see already. It has went down 6.2% since March and by just under 3.5% in San Jose and Oakland. Again, you can see that the vacancy rate had gone up quite a bit, 12.9%, and then 6.2 San Jose, Oakland 5.2. But I feel like it's probably going to be even higher, just like what Marty was just saying. When you guys underwrite, probably you have to use a much higher number. But then people are still quite confident over the Bay Area's long-term housing dynamics. So I think that is also another reason why we are still seeing very strong housing market in terms of the 1 to 4 units. And then this is like differences between Class A, Class B, and Class C properties. And you can see the rent growth. That's what they are projecting, is that the rent growth for Class A obviously is very, very small. And Class B is slightly better. But Class C, on the other hand, actually is doing pretty well. This is changes in US and on average. And then the vacancy, same thing. Very interesting. You see Class C has the lowest vacancy compared to Class A and Class B. So this is going to be quite different for people to look at properties to buy in the future. Here again is that less dense and lower cost metros near large gateway hubs are showing more positive multifamily performance. So again, people want to be close to the gateway, the big cities, but then they might be a little bit further out and a less dense area. Last slide. Just want to show a little bit about like San Francisco, talking about the companies signed new lease only on 266,000 square feet on office space in the second quarter, the lowest level since at least the 1990s. Silicon Valley, same thing, the lowest rate in 16 years. And then on top of that, there's this Prop 15. The split roll is a job killer. This is, if you get to vote for this, please be sure to vote no. Anyone of you want to talk about the split roll? No. So they are basically proposing that they want these commercial properties to pay property tax based on the market value of that year instead of the 2% increase, so that can increase the revenue for the city. But at the same time, we all know that if you increase property tax on the commercial property with triple net everything, they're going to pass it down to the tenants. The tenant's going to pass their cost down to the consumers. So I'm against it. So that's another topic, I guess, some other time.
Hey, Helen, somebody asked what are Class A, B, and C units. Do you want to tell them?
Oh, so let me go back here. So Class A, Class B, Class C. Class A is very subjective, really, but then Class A typically is like the high-end properties, and Class B is a little bit middle ground, and then Class C is a bit lower end. That's the easiest way to explain without going into detail, because in every city, every region could be different how you look at Class A, Class B, Class C. Thank you so much for watching our YouTube channel. And don't forget to subscribe to our channel, like our videos, make some comments, because we're going to keep you posted on the most updated real estate news, housing market data, and also real estate tips and advice from all over the real estate industry. So thank you so much for watching, and I'll see you next time.